Imagine you walk into your local branch and hand over $1,000 in cash. You probably picture a heavy steel door swinging shut, keeping your stack of bills perfectly safe until the day you need them. In our last episode, we established how banks actually create new money every time they issue a loan. But that raises a rather obvious question. If banks can generate money when they lend, what exactly are they doing with the hard cash you just handed to the teller? Your bank is not operating a passive storage locker. The moment your money crosses the counter, the bank puts it to work to generate a profit. Your deposit does not sit idle. It is immediately fed into a financial engine designed to multiply cash and create money that moments ago did not even exist. The core mechanism making this possible is a strict mathematical split. Banks operate by dividing incoming cash into a small pile of held reserves and a much larger pile of outgoing loans. This diagram shows how your $1,000 deposit breaks down. The bank keeps a small fraction, say $100, in reserve, and pushes the remaining $900 right back out the door as a new loan. That $900 enters the real world. A borrower uses it to pay for goods or services, like purchasing a car or stocking a storefront. The person who sold that car or those goods now has $900 in cash. Naturally, they head to their own local branch and deposit that cash. The cycle repeats. This second bank keeps $90 as its reserve and lends out the remaining $810 to a brand new borrower. This process of depositing, reserving, and lending happens continuously. The cash cascades through a vast network of branches and borrowers, a process economists call the money multiplier effect. Through this relentless chronological chain, a single localized deposit mathematically inflates the total volume of money circulating throughout the broader economy. Why do financial institutions facilitate this complex, endless loop? The answer is driven entirely by profit. This chart shows the concept of the interest spread. The bank might charge a borrower 10% interest on a loan, while paying you only 2% interest on your deposit. The institution keeps the remaining 8% as its revenue. But this model carries inherent risk. By design, the vast majority of the physical cash depositors handed over is out circulating in the real world, rather than sitting securely in the vault. If a panic sets in and every depositor demands their original cash back on the exact same day, the math breaks. The institution simply does not have the money on hand to pay everyone, a collapse known as a bank run. To prevent these systemic collapses, central banks and national governments enforce strict regulations, requiring banks to hold specific minimum reserves. Modern banking operates as a precarious balancing act. Institutions maximize their economic profit by lending out as much cash as they legally can, while holding back just enough liquid reserves to prevent widespread panic. Beyond the balance sheets and profit margins, this constant flow and multiplication serves a vital societal function. It is the engine that actually funds local businesses and creates jobs. Money sitting idle in a vault accomplishes nothing. Multiplied money, moving rapidly from borrower to merchant to bank, keeps the global economy active and growing. In Episode 1, we proved that issuing loans creates new money. Here in Episode 2, we see that customer deposits serve as the base fuel to multiply it. Yet this ever-expanding system introduces a major macroeconomic problem. If banks are constantly pushing more and more money into existence, what happens to the inherent value of each individual dollar in your pocket? As the total money supply steadily expands, the purchasing power of your cash slowly degrades over time. In our next episode, we will break down the precise mechanics of why inflation happens.